Okay, we start today's market talk. Managing the current account, financing it, and keeping the rupee from sliding further are central macroeconomic imperatives for FY27. And this is the word of the Chief Economic Advisor of India. So, Indian currency has hit a fresh lifetime low and has fallen 12% in 1 year. So I'll just show you the movement of currency. So if you see, it just collapsed on in the last week and touched 96, and it is moving directly with the price of dollar. And last 1 year, it has been impacted due to US tariffs, AI narrative, how Middle East war has added to the problems, etc. And reason for rupees fall is the persistent in outflow of dollars, and in addition, with Indian crude basket around $100, a supply decline on the horizon due to Middle East problems, India's current account deficit is expected to rise sharply. And in addition, RBI has its own short dollar positions extending to around $100 billion. Hence, RBI is finding itself in a difficult situation to daily manage the rupee volatility. So expect some kind of wide range of measures. It has started already. Like today, in the morning, there is a measure to curb the import of silver, etc. So wide range of measures to will be announced over the coming months, so as to strengthen the currency, because this kind of fall is very healthy for the economy. Now, in the market outlook, firstly, impact of Hormuz crisis has finally started to hit the Indian households now. Till the time the households were protected, but now with the petrol and diesel price hikes of rupees 3 a liter, so it has started hitting now the Indian households, and there is more to follow. Every fuel price hike will add to retail inflation. April WPI point to a clear cost push inflation impulse. It will flow to retail inflation also through higher transport, freight, logistics, and imported input costs for various products. So, energy intensive sectors such as manufacturing, logistics, aviation, construction, fertilizers, etc., are already facing margin pressures. So, like if you would have seen when I write the results, I am writing very clearly how the margins are changing. I'm not bothered about earnings or profit. It's more about margins, because you have to watch that aspect very clearly, because some of the stocks or companies, the margins are really taking a big hit even if the revenues are going up. Now, till now, the India's energy strategy was to buy cheap oil, burn it, and grow the economy. That era is over. So, changes in energy market are structural, not cyclical. So, these are likely to be there. It is not now that within after 1 month, crude will come down to $60. It is not going to happen. So, it's a structural problem. Hence, government is taking good measures. So, see, coal shipments are higher in various countries, and in India, there is a scramble for gas alternatives. Recently, the Indian cabinet approved 37,500 crore incentive scheme to promote the gasification of coal and lignite. So they are also taking adequate measures. Now, the key issue: how should investors respond to Prime Minister's call to tighten their belts? So he gave a call to cut down expenditures in basically imports, all the things which we are importing as a country, cut down expenditures. So how it will impact? Now listen to this. Firstly, jewelry sector. Organized jewelers may emerge stronger despite near-term demand disruption from higher gold duty. Because what happens is the impact on the unorganized jewelers is very high. So they do not have that kind of, they cannot take that kind of rise of cost, and they do not have that kind of inventory, etc. So that is the problem. So these guys will be able to manage the issue much better. Then autos, EV linked and premium auto players may outperform the smaller players, because if the fuel price goes up, and the auto components prices go up, the auto prices also have to go up. But the people will start switching to electric vehicles, etc. So those will benefit. Then aviation, travel, and discretionary demand may face pressure. Already, you are seeing the problem with the with the fuel for the aviation stocks. Cement, you have to watch for companies which are saving on energy cost, because the energy cost is going up. That is the key input for cement, and operational efficiencies will serve as a primary differentiator for margin resilience. Hence, the bigger players who are very efficient, like Ambuja, Oblique, Ultratech, will benefit as compared to others. And why I'm saying cement is because now to manage the economy, the government will have to spend more. And so basically, it is construction, so cement demand will not really go down. Chemicals. The problem with chemicals is global recession remains a risk, because then the demand is lower. Discretionary items like apparel, footwear, quick service restaurants, hotels, they will get impacted because people spending power reduces. Then value fashion retailers, they will benefit because people are looking for cheaper alternatives. So bazaar style retail, V2 retail, things like D-Mart, Vishal Mega Mart, etc., who are selling lower quality, lower price stuffs will benefit. So one will you will see the differentiation in a short time. Then alcoholic beverage companies like Radico Khaitan, United Spirit, they may face pressure due to higher ENA, glass, and packaging and logistic cost. So their margins will also get impacted. Consumer durables, ACs, electronics, smart appliances may face slowdown due to deferment of discretionary spending, may face supply chain disruption and margin pressure due to dependence on imported components such as semiconductors, batteries, and display panels. Then food delivery and quick commerce platforms like Swiggy and Zomato, they remain vulnerable due to rising last mile delivery cost. I don't know how much pricing power they still have, right? They can't just keep charging more, but their costs will go up. Then there would be a slowdown in CV demand. So the CV manufacturers, vehicle financiers like Shriram Finance, Mahindra Financial, Chola Investment will also be under pressure. So one should be careful, and it is getting already reflected in the stock prices. And as now, if you see, due to the impact of all these issues, the Indian bond yields are moving up. They had come down because of some of the measures the government had taken, but have quickly bounced up. So now they are moving up, and once the market starts pricing a rate hike, and then the bond yields will start moving higher. It came down because there was some talk about India reducing the taxes on foreigners who are investing in, who are moving out of Indian bonds, etc. But it is just one of the measures which is being discussed. Nothing is implemented on ground. Coming to FIDI data, FIs, to see they are short on index futures, though added some longs on Nifty on Friday, but they are net short. If you see here, they have sold index option calls, bought index option puts, right? So they are strong bearish. But pros, if you see pros, they have they are long in index futures. They have bought index option calls and bought index option puts also. So they are kind of indecisive right now. Generally, they're at the same place, so you can't really make out. And there has been some short covering. I'll show you later. Now, clients. So if you see the clients, they are long on index futures. Bought They have bought index option calls. So if you see, they are net long, but they have reduced some positions, and they sold index option puts. So they are strong bullish, the clients. So if you see, last week, the FI short positioning went up to 2.38 lakh short positions in index futures, and in the last 2 days, they covered their certain shorts, and the market also moved up. So now from here, they can still start adding short positions or whatever way they want to add. We'll have to watch that. Now, and on one odd day, they sold big amount in cash, and that day they were short otherwise also in calls, puts, and index futures. And the market went down 1.49%, and then on 12th, it went down 1.83%. Basically, on all days, FIs were shorts, and then they turned bullish, and then the market went up 1.18%. So these movements are every day taking place because of uh, short covering and all those other issues, and nothing really different is happening. Now coming to US, so if you see the US CPI strengthened in April, so CPI WPI is higher, and the US Treasury yields have surged. Now if you see, there is a declining trend line here in the US 10-year bond, and it has crossed that level. Now this kind of move makes Trump mostly jittery. It happened in earlier here, right, in April, and then he did the taco here. So one has to be very careful. It happened when he was talking about this Greenland, and then again, he came down. So just be careful. There would be some round of taco taking place shortly. So that's what I'm saying. Once the yield reach this level, there is a chances of his retracement goes higher. So the bond 10-year yield is above 4.5, and see, the because of that, the dollar index has also moved up. It has moved up to 99. So right now it's okay. It's within a range, but it is above the 20 EMA. U.S. President concluded his visit to China without any major breakthrough on trade with Iran. So if you see, and then the U.S. markets tanked on Friday because of yields going up and no breakthrough with China. So see, Brent crude prices are up, and this is what leading to decline, one additional decline in the rupee because of problems of current account deficit. Gold has corrected. If the and it is below 20 EMA, one should be careful. So watch for this 4400 level. If this level breaks, then maybe around 4,000, but that should be a good opportunity to enter this gold, because in India the gold prices will not come down because the rupee is weakening. So watch for this. It is coming down because the bond yields are going up and the dollar index is strengthening. Same with silver. It went up to 90 and it corrected, and now it corrected sharply. It has now come down to the 20 EMA support. So if watch for the 70 level, $70. If it breaks, then you may see next support would be somewhere around 60 or 50, but that should be a good opportunity to buy. Now there's a probability that Indian silver market will delink from the COMEX because of the government's restrictions and all that. So you have to watch what the MCX silver is doing. That will maybe trade at a premium as compared to the COMEX prices. Again, like all metals, copper also corrected. Bitcoin also corrected as the yields are going up. It has come down to now the 20 EMA. Let's see what happens from here. S&P 500 was flat. It made a fresh high and then corrected. Similarly with Nasdaq, similar action, flat, and Dow Jones also. It went up to 50,000 and then so US indices were generally flat. Nothing much here. Now India VIX, if you see, rose 11.58%, reflecting nervousness and elevated risk perception. So the VIX is going up, and that is why if the VIX is likely to go up, buying option is not better, because once the VIX declines, you will automatically face some losses, because if you're buying options, you're expecting the premiums to go up, not to come down. So this will be favorable to the option sellers. Nifty, if you see on the weekly chart, made a red candle and broke a crucial support. So watch out for this. Made a low, but then subsequently sold off. It is getting stuck in this range. It fell around 2.2%. So now if you see the daily chart, there is a gap here, right? And this is the level of 23,800. Now this support has been broken, and after that Nifty has faced resistance here. For the whole week, it broke through that level, 23,800, and this lower level is 23,130, 140. So this is the range. Watch out for this level. This should be a support, but if this breaks, then it will go down to 23,000 and below. So right now the momentum is down, and if you see on daily charts, Nifty is below all moving averages. So it is bearish right now. There is no bullish thing here. The upper levels to see are 25,000, and this is 24,600, the last high. and now it has slowly come down, and now it is facing resistance at 23,800. So support, I said it's at 23,150. Resistance 23,800, 23,900. Now if you see Nifty Bank weekly chart, it corrected 2.89, more than that, and it is, if you see over the week, last 4 weeks, Nifty Bank is making lower highs and lower bottoms. So it is more weaker as compared to Nifty, because of expectations of interest rate and slowdown in the economy, etc. Again, it is in that gap and trying to fill that gap. So here again, the support is at this lower level, 52,800, 820 levels, and resistance would be this moving average, the 20 EMA at 54,840, 50 levels. So that is the gap. But if this breaks, then it will go and test the lows it made in April. So 50,000 becomes possible, not immediately, but a lot of stop losses get triggered, etc. Be careful. So Midcaps also corrected. It corrected 2.23%, but they have moved up very nicely. So this is just profit booking. Similarly, with small caps, they had moved up very sharply from the lows in over from April, March onwards. So they are correcting now. We'll have to see. There's some profit booking taking place here. Now the weaker stock is HDFC Bank. It is facing resistance. It is making, if you see weekly chart, it is making a straight downward trending pattern, lower highs, lower lows. So one should be careful. It will face resistance at this 800 plus level now, and support is at around 700. If it goes there, so we watch for this. This will drive the market. So if you have to really move the market, you can straight away move HDFC Bank and move the markets in India. And I think this was done on Friday. Reliance bounced from the 200 EMA on the weekly chart. Beautiful bounce, went up to 1400, 1460 odd, and then has corrected, and now it is heading again there. So watch for this 1315 level, because nothing had changed. So this move up was for no reason, and now for no reason also it is coming down. There's profit booking. Now the accident of the week was Keynes Technology. So I had mentioned to be careful with its earnings, because after the earnings, the performance is very violent, and it has come down in the last 2 days after earnings with large volumes. So that means there is lot of unwinding of long positions, etc., and short covering which is taking place, and now it is looking weak. So if this level at which it is at 3270 odd level, if this breaks, and then you may see levels below 3000 also here. So I'll cover two stocks now. First is Waaree Energies. It is developing a 3.5 gigawatt hour integrated BESS manufacturing facility in Valsad, covering cell to pack and containerized storage systems. Management highlighted plans to build India's first fully integrated. Sorry, I think we have moved. Yeah, it is India's largest solar PV module manufacturer, holding roughly 21% domestic market share, and stands as the largest non-Chinese module manufacturer globally. Management has shared an aggressive 30,000 crore capex roadmap to transform the business from a pure play module manufacturer into a vertically integrated clean energy platform. They are doing capacity expansion, expanding solar cell manufacturing from 5.4 gigawatt to 15.4 gigawatt over the next 2 years to limit reliance on imported cells. Global aggregate module capacity sits at 22.3 gigawatt, including US operations in Houston. Backward integration, they are progressing on a 10 gigawatt ingot and wafer facility, alongside venturing into emerging adjacent sectors, BESS, and integral 20 gigawatt advanced chemistry cell facility in Gujarat, inverters and green hydrogen electrolyzers. Board recently approved a 10,000 crore fundraise through a QIP or alternative equity debt instruments, etc. Now, this is the reason why this stock is correcting, because there is so much of equity dilution is likely to take place. So that's why people are selling off. They don't know at what price the QIP will come. Right now, the market cap is around 86,900. So it is roughly 10 to 15% equity dilution, and that is what is bothering the market. Because as I mentioned, if you have to grow, you have to do so much of capex, you require cash. So either you borrow, so that raises your finance cost, or you do equity dilution, and that's what these guys are planning to do. Management targets 1 lakh crore revenue by 2030. Growth visibility improving across segments. So if you see for them, this C&I, that is commercial and industrial segment, is doing well. The PM Kusum scheme, rooftop solar, uh, witnessing sharp acceleration. And with so much of energy problem, there is so much of interest in these solar modules, etc. Staying relevant will require continuous technology transition and deeper backward integration, because they are competing against China. Now it is developing a 3.5 gigawatt hour integrated BESS, battery energy storage system manufacturing facility in Valsad, covering cell to pack and containerized storage systems. Management highlighted plans to build India's first fully integrated gigafactory, spanning cell manufacturing by containerized BESS solutions, with an aim to become a fully integrated 20 gigawatt hour player by 2028. So they've got good capex plans. Management outlined its long-term Waaree 2 roadmap, requiring capex of 32,000 crore over the next 2 years, targeting the creation of a fully integrated clean energy manufacturing ecosystem comprising 28 gigawatt module manufacturing, 15 gigawatt cell manufacturing, 10 gigawatt ingot wafer capacity, 20 gigawatt hour BESS manufacturing facility, 4 gigawatt inverter manufacturing capacity, 20,000 MVA transformer manufacturing capacity, 1 gigawatt electrolyzer manufacturing capacity, 2,500 TPD solar glass manufacturing. Now, what is TPD is tons per day to measure the melting capacity of solar glass furnaces. This is how their capacity is measured. So 100 TPD furnace would support roughly zero point 0.6 to 0.65 gigawatt hour of traditional single glass solar module production annually. Then polysilicon manufacturing capabilities, etc. So they are doing full amount of backward integration. Its US module capacity is expected to reach 4.6 gigawatt versus 1.6 gigawatt now in the next 6 months. With further capacity expansion planned, it has already signed 2 gigawatt of PPAs under its independent power producer portfolio. So it is going into that side of IPP also, where they will give power to the grid. So that is also good and will help in margins. So you see, in the last quarter, they nearly doubled their revenue year on year, because of so much of cost issues and other expenses. The EBITDA was up 71%, margins declined, but they are in generally 20% range, and the PAT was up 74%. But it's a and for the full year, if you see, the PAT doubled. So they have done well. Uh, Strong visibility of maintaining momentum in FY27. So they have performed well with good capacity, and project execution is on track. Execution of cells and ingot wafer facilities remain on track. Strong ramp up in inverter and transformer segment, BSS. And now there is so much of requirement of BSS. It is because people have realized that the solar power is there is overload in the daytime, but at the night time the people have to start using conventional power. Hence, because of lack of storage facility, so there is a lot of emphasis now on BESS. Green hydrogen electrolyzer, etc. facilities continue to progress on expected timelines. So they have guided for around 7,000 to 7,700 crore operating EBITDA over FY27. So if you see here, they did around 5,900 operating EBITDA. So they are from here talking about decent growth from FY26. So generally they are talking about 20-30% growth, but at that size, that is good. Now they are planning, as I told you, 32,000 crore, that is 3.5 billion capex, taking Waaree from Waaree 1 to 2. So Waaree 1, 26 gigawatt, largest module manufacturer, and 5.4 gigawatt cell facility, and they are moving up in value chain by backward vertical integration with capex, making solar module cells, ingots, wafers, etc. Then EPC, O&M, technical services, inverters, smart meters, transformers, BESS, electrolyzer, green hydrogen, RE power, infrastructure, and TN transmission, and moving into a setup of Waaree 2, I think 2030 expected. Please switch off your volumes. So they are doing well. Now, solar installation gigawatt in India, FY 22-23, they have increased year on year. Switch off your volumes. If you see in FY 26, they have done roughly 40, uh, total 40 gigawatts divided into utility. Utility is basically the those solar parks, the big large scale. Then C&I, as I told you, commercial and industrial. Then Kusum under PM Kusum, and then rooftop solar. So they are into all these fields, and that's how their revenue split is there. Maximum in utility, IPP, and C&I, then retail, EPC, overseas, etc. And margins, though they had peaked in FY 26, expected to go down. Costs are going up, they're doing capex, etc. But still, they are sustainable 20%. Now they are expected to grow. They have grown pretty fast. Now expectations are slightly lower, 20-30% growth over the next 2 years. EBITDA remaining at 20%. So it should do around 45, 62 crore of PAT and 54-38 crore of PAT in FY 28. So taking a mean of around 5,000 crore, and as I told you, the present market cap is around 86,900 crore. So it's at around 17-18 times, not expensive with the scale and the opportunity size which is there. So it is expected to do around 158 rupees of EPS in FY 27, and PE is for FY 27 is around 20, but if you take a median, it's around 18-19 for FY 27-28. EV EBITDA has also come down now at around 10. It becomes inexpensive with this size and reach and all that. So generally they're doing well. Now if you see the chart, it had made lows when the Trump had put additional tariffs on people importing solar products from abroad, etc. Or it has gone up, and now because of this QIP news, it has come to very important support. It has come to its 200 EMA. So now this level is very important. Now if this breaks, then have to see where it stabilizes. It can go down to any level. You never know if there is a selling, but adding at below these 200 EMA should be a good opportunity in case you're a long-term investor. The other stock is KPI Green Energy. It continues to benefit from secular tailwinds in India's renewable space, leveraging its dual engine model of selling power directly, IPP, and setting up plants for corporate clients, CPP. For FY 26, revenue EBIT PAT growth of 55, 70, and 49% year on year to 2696 crore, 958 crore, and 476 crore respectively. Growth was mainly driven by the CPP vertical, captive power plants, which they manufacture for the on contract for various people. Like all these industries nowadays, various industries are creating captive power plants for themselves. So they are taking up these projects, which grew 61% year on year on the back of strong execution. In IPP, where they are producing power themselves, it energized 447 megawatt in fourth quarter FY 26, taking the total operational capacity to 975 megawatt. It can potentially generate nearly 180 crore units annually. It is targeting another 100,000 megawatt execution in FY 27, taking total capacity close to 2 gigawatt. IPP revenues margins are higher if you are supplying power, so are expected to grow more than 2x to 559 crore in FY 27 from 248 crore in FY 26. The operational and outstanding order book of 1.6 gigawatt can potentially generate around 500 crore units annually, assuming 22% plant load factor. Uh, CPP in the captive power plants, the current CPP order book stands at around 3 gigawatt, translating into an order book value of nearly 4,500 crore. Management expects to execute approximately 1500 megawatt in FY27 along with fresh order inflow of nearly 2 gigawatt. BESS capacity expected to come fully operational in FY27 is likely to start contributing to revenue from FY28. So they are also into this capex phase. So if you see here, year on year, they did around 39.8% revenue growth. EBITDA was up 80% because of higher IPP revenue led to better year-on-year EBITDA margins, and they did net profit growth of around 49%. So they have done well. The reason why the profits have dipped is also because the finance cost, as I told you, debt is higher. So finance cost has gone up, and from see it has nearly become 4x from fourth quarter FY25. So this is the reason, because once you execute so much of projects, you require money. So if you see the margins, operating margins have improved, and so that should be helping the profits, etc. Though net profit margins have not improved that much, or generally are stable because of higher finance cost, etc. Uh, so if you see, they did around here. If you see, they did 41 crore units, kilowatt or 1 kilowatt hour kind of thing in FY26 into various segments. 9% revenue share has come from IPP, and that is independent power producer, and 91% from CPP, which is captive power producer. So IPP, they should have a capacity of 2.57 gigawatt total, and then 3.69 gigawatt in FY27. They should have portfolio capacity as the projects they are doing, and portfolio hybrid uh, capacity utilization factor on AC basis in FY26 was 50.6%. They have a lot of plants located strategically across various discoms, like as mentioned here, in various states. So they are able to do their IPP thing better. Now, if you see their total portfolio gigawatt hour, uh, FY25 versus FY26, it has grown well, nearly uh, grown 70-80%. And IPP segment has also grown. So installed is 0.96, work in progress 1.61. Similarly, CPP 0.66, installed, work in progress 3.03. So they are total 6.26 gigawatt of overall capacity in IPP and CPP combined. Uh, so if you see power producer units per because of their IPP improvement per quarter, they have been improving up. Though realization per unit has come down, and that is impacting margins. CPP closing order book is up, and similarly with IPP. So they are getting good orders and order inflow, and so that way they have revenue visibility. So they have won various orders: 300 megawatt wind power project, 120 megawatt, 240 megawatt hour IPP standalone, etc. And then 44, 45 megawatt, 890 IPP standalone wind power projects, plasma green hydrogen plant, floating solar voltaic project, solar power project, etc. awarded by Adani Group and all. So they are executing these projects. Future, they are expanding into BESS, into energy trading, advancing green hydrogen projects, advancing floating solar initiatives, offshore wind opportunities, pump storage projects, etc. So they are doing all these things. Now, if you see here, vis-a-vis FY26, they are expected to grow around 46%. And so generally, they should do a CAGR of 40% over the next 2 years. Margins are now improving. So from 30 lower 30s, 32, 33, it has moved to 38.9 and expected to go to 40s. Uh, the interest expense has gone up. This is what I highlighted. So this has to be monitored, and that is impacting. But that is the cost one has to pay. PAT growth has been decent, so it is expected to grow 36% and do a EPS of 31 rupees in FY27, and 47 they are projecting. So let's assume 40 also in FY28 should be a mean kind of thing, uh, giving the mean of both the years. Uh, so EBITDA margins are improving, ROE is improving, gross debt has to monitor, it is going up. They should be able to manage So one has to see what is their EBITDA. EBITDA was 1536 crore, and their interest expense was 376. So it is still manageable. They are earning more than their required payment, so that problem is not there. Now, if you see, as I mentioned, 40 bucks, it is now at 420. For future earnings, it is at around 10, 11 times right now. And it is again corrected after the earnings, it went up and then has corrected, sold off. But the point to be seen here is it is making lower highs and lower lows. So one has to be careful. Basically, the market is selling it off because of higher interest cost and higher debt, etc. But it's a decent business to hold, and so it had moved up. So if you see, the lows of March were 340 odd, and from there it went up to 500, and that is nearly 50% move. And now it has retraced. So if you see, it moved up 160. It has retraced 50%. So I think somewhere closer to this 400 odd should be a decent support for this stock, because that would be 61% retracement of this complete rise. So keep a track and buy on dips. I have finished. We'll take questions now.